So today I want to take you through my rental property here and kind of go over some of the numbers with you to just make sure that you are profitable if you ever purchase an investment property like this. And at the end of the video, I'll show you how I actually bought this house for only $500 out of my own pocket. Let's take a look inside. So we're actually getting a brand new tenant moving in on Monday. So I'm kind of over here kind of fixing up some last minute things. So on Monday, we're going to start getting $1,900 a month. That is what the rent will be for this property. And our mortgage is actually incredibly low on this. Our mortgage is only $1,350 a month. So right off the bat, you may be saying like, wow, you're making a huge profit on that rental property. But if you were to think that, you'd be thinking wrong. There's actually a lot of expenses that you want to deduct from this $1,900 a month before you really figure out your profit. And the first one you want to deduct is going to be your vacancy rate. So what this means is that you want to deduct a part of your monthly mortgage payment every single month to factor in for the time periods between tenants. So this house was vacant for about 1 month between the last tenant and when this new tenant moves in. So that's one entire mortgage payment pretty much that I need to make right there. And I'm also kind of losing some money as well, because that is rent that I'm not making that month. So what you want to do, some people tell you to deduct 10%, let's get rid of this, 10% of your monthly mortgage. I actually like to deduct 8% of my monthly income because there's 12 months. So if you have the house vacant for 1 month out of the year, that works out to about 8% of your monthly payment. So if we deduct 8% for vacancy rate, that is $152 a month that you want to deduct from your monthly rental income to kind of compensate you for those time periods when your rental property is going to be vacant between renters. Now, the next thing that you want to factor for is your maintenance costs, because even though you have a tenant in there, you're still going to have some maintenance issues. And even if you have an entire year without any maintenance issues, the next year you may have a lot more maintenance issues, or maybe the year after. So if you kind of average that out over every single month, right? You take your maintenance costs over 5 years, you average it out over every single month. You want to deduct that from your monthly income just to make sure that you are in fact profitable. Now, they say that this should be between like 5 and 10% of your monthly income, and that number is really based off of your house, right? If you have a newer home, that number can be a lot less, right? Newer homes probably don't have as much maintenance and issues are going to happen. If you have an older home, you buy a rental property that's, you know, from the 1960s or something, that's going to have a lot more maintenance issues that you're going to need to take care of. This is a pretty updated home. We put a lot of money into it before we put it on the market. So I'm going to deduct 5% from my monthly income for maintenance cost. And so that adds up to another $95 a month that I'm going to be deducting from my monthly income. So the next thing that you really want to factor for is what they call Capex, capital expenditures. So these are not factored into your annual maintenance. These aren't little things. These are really big expenses that come around every 10, 15, 20 years. You know, at some point, if you have hardwood floors, you may have to tear up all the hardwood floors. You're going to need a new roof at some point. You may need to get a new fireplace. These big expenditures that don't come around very often. And once again, this is going to be kind of influenced by the age and condition of your property. And, you know, if you want to play it safe, go with like 10% of your monthly rent will be going towards that. But this is a fairly updated house. So once again, I'm going to go with 5% for this number. So 5% of my monthly income will ultimately be going towards a new roof that I may not have to actually pay for another 5-10 years. Now, the last number you want to factor for is property management. Property management across the board is usually, they charge about 10% of your monthly income every single month for a property manager to kind of maintain it. I've had property managers in the past, and honestly, you know, I keep good condition of my rental property, and I went like an entire year without any issues, and I was like, what am I paying this guy for? And I actually live just 10 minutes down the road, so I'm going to be managing this property myself. Once again, this one doesn't have a lot of maintenance issues. I take good care of it, so I don't expect a lot of things to be breaking or a lot of issues that I need a property manager to account for. So we're not going to do property management. So if I add up all these expenses plus my monthly mortgage payment of $1,350, so really my profit every month is going to be about $227 a month in cash flow. Now if I did have a property manager, that would take away another $190 a month going towards a property management fee. So you can see, even though I have this huge gap of $1,900 income and only $1,350 a month in my mortgage payment, there's still so many expenses, and this is where people screw up and why so many people are actually not profitable on their rental properties even though they think they are. Now, cash flow is actually only one of 3 ways that you actually make money owning rental properties. Now, cash flow is only one of 3 ways that you actually make money by owning rental properties. Another really big way is appreciation. So appreciation is how much your home's value increases every year. And on average, homes increase about 3% a year in value. Now, in 2020, over the last 12 months, home values have actually skyrocketed and jumped up 8% in the last 12 months. So on a $400,000 house, the last 12 months, your home's appreciated about $32,000 in value just by owning that property. And the great thing about this is that you can really leverage your money. You know, if you put 20% down, it's not just your 20% that is increasing 3% in value, it's the entire thing. And with loans like FHA loan, if you buy a house, you only have to put 3% down. And this is huge. And this is actually a lot of investors will buy an investment property, even if it doesn't cash flow positive. Then the last way you really make money with an investment property is debt pay down. So let's say you have a mortgage. Every single month, your tenants are paying off your mortgage for you, building more equity in the property. So if you get a 30-year loan, you just have to keep a tenant in there for 30 years. They'll pay off your entire mortgage for you. Plus, due to appreciation, your house may double or triple in value in 30 years. So it's definitely a great investment. And I do work with a lot of investors that they just want to get in the market. They're not even concerned if they can break even and be cash flow neutral. So it's not really costing them any money. They just want to be in the market and take advantage of that debt pay down and the appreciation. So I mentioned before, I was actually able to purchase this home for only $500, and that is true. That is all that I put down. So we're talking about leverage, $500 down, and I now have an asset that's about $280,000. That asset is now appreciating, not just my 5%. But how did I go about doing that? Well, I used the VA loan. I purchased this home as my primary residence at the time of purchasing, and you can do that. You can use the VA loan and FHA loans in order to do that. And then I moved out afterwards and turned it into a rental property. And that's perfectly legal to do and within compliance with the VA loan and everything. You just have to live in the house for 12 months. And when I purchased the home, so with the VA loan, you put $0 down towards the loan. And I was able to get the seller to pay all my closing costs. So really the only expense I had when I bought this house was just my $500 to go towards the home inspection. And that is it. And I was able to move right into this property. It's actually one of my favorite techniques to acquire your very first rental property is simply buy it as your primary residence first and then move out and turn it into a rental property later on down the road. And so I originally bought this house in 2010 for $210,000. Today it's worth about $280,000. So through appreciation over the last 10 years, I made about $70,000. And in that time, my tenants have been paying down my mortgage for me. So now I only owe $180,000 on that mortgage. So that's another $30,000 in equity that I made. So just by owning this property and just owning it, having tenants in there, I've built $100,000 in equity in this profit on top of the $200 a month cash flow that I'm making from this property. So if you want to learn more about real estate investing, check out this video I did right here. Thanks so much for watching. Don't forget to subscribe for more real estate and personal finance videos, and I'll see you over in this next video.